Today, I'm going to tell you about one of my favorite strategies that can profit both in uptrend and sideways markets. The strategy is the wheel, and I will show you how I use it to get stocks at a discounted price and improve my buy and hold returns with minimal additional screen time. So, how does the wheel work? Well, you start by selling a put. At expiration, that put either is not assigned, and then you pocket the credit you received, and you profit and you restart, or if assigned, you are now owning 100 shares of the stock and you sell a call against those shares. Once you sell a call, once again at the expiration of the call, you have two options. Either you are assigned, and in that case the stock gets called away and you restart the wheel process, or not assigned and you keep selling calls and decreasing your cost basis by collecting more and more premium. So you can see why this is called the wheel. It turns into kind of a circular process that always rotates. If this was a little bit confusing, don't worry, I'll guide you through a real example and we'll break this down step by step. So step one is selling a put. You start by selling a put. You have to select a stock. For this example, I pick NVDA. At the beginning of 2026, NVDA is the biggest market cap in the world. I think it's a prime candidate for the wheel because if we look at the chart, we can see that the stock has essentially gone nowhere for the past 6 months. If you bought it back in October over here, and now we are at the end of January, you can see that you would have made essentially $0 buy and holding. I'm going to show you how the wheel can improve that and maximize your returns, and how you could have made about 10 to 15% returns during this period if you had used this strategy instead. Okay, so let's look at NVIDIA chart in more details. And let's say that you see that NVIDIA is a stock you want to hold, but it has not been moving a lot. So you are unsure about just buying the stock. It's not rallying, although the long term is still on an uptrend. And let's say that the recent swing low is about 178. So you define that you want to sell a short put around there, as if the stock drops at that recent swing low, you'd be happy to own it at a discounted price. So we go into the options chain. Here I'm pulling the options chain from TradingView. I usually like to pick 25 to 30 days to expiration. So I'm going to go to February 20th. That's about 25 days to expiration. And I'm going to take the strike closest to 178. Since 178 does not exist, I'm going to take the 177.5 and I'm going to sell a put. When I sell a put at this strike, I'm going to sell it for about, let's assume, $365. That is the latest traded price. And I usually like to pick a delta of about 0.3. The reason why I like 0.3 delta is that there's a relatively low chance of getting assigned, but you get to collect a big chunk of premium. So this is my feeling, and you can adjust this as you'd like. If you go to a lower delta, you minimize your assignment risk, but you collect less premium upfront. And conversely, if you go to a higher delta, you maximize the premium you collect upfront, but you have more risk of having assignment and having to manage this position. It's up to you how you prefer to trade this strategy. For me, I like about a 30 delta. Okay, so let's say we sold this put. We sold the 177.5 put on NVIDIA, and we collected a credit of $365. Our risk is the $17,750. So that means if we are assigned 100 shares at the strike of our put, minus the $365 that we already pocketed. So that is our credit received. So you can see here how if the ride is smooth and you are just getting your returns on your puts, you get about 2% in 25 days, what annualizes for more than 30% in 1 year. So at expiration, there's really two options. The first option is the price is above your strike. It might have gone a little bit up, it might have gone a little bit down, it doesn't matter. It's either above or below the 177 and a halves. And in that case, you just profit, you sell a new put, and you restart the wheel. So you can see how this strategy is perfect if you don't have the time to actively trade day in and day out, and you just want to set your positions and come back at expiration 20 days later, 30 days later. It requires really minimum screen time, maybe 15 minutes per month. Option number 2 is the price went down and is now below your strike. So when the price goes down and in the money, so below your short put strike, you are obliged to buy 100 shares at 177 and a half. So that's the obligation you got from selling your put. Let's take an example and let's assume the price went down to $170. In that case, you have a paper loss of $750 on the shares. You were assigned at 177 and a half. Price is trading at 170, so $750 loss on the shares. That's a paper loss. You are still holding the shares. But in your pocket, you got $365 in the put credit. So in reality, your loss is less than $400. You can see how this compares with buy and hold. If you had bought the shares back in 187 and then it dropped all the way to 170, you'd have $1,700 in loss. In this case, you only have about $400 in loss. So you can see how this strategy can be much better when the stock is not rallying higher and higher. So what do you do after this? Well, you sell a call. You sell a call against your shares and you collect more premium. So let's go into that. Let's say you are assigned 100 shares at 177.5 and you want to sell a call above cost. Usually I like to sell calls about 20 to 30 days to expiration. In this example, we're assuming that the price came down and is now trading at $170. So let's say that we want to sell a call at 182.5. So you can see between 182 and 170 we have $12.5. So we can estimate how much this call is worth by adding $12.5 to current NVDA price. We would be slightly above $200. So let's take the, once again, 25 days to expiration call and let's sell 200 call for this example. We can sell a 200 call for 296, so we would be getting $296 and your risk is decreasing. As you sell more calls, you decrease the risk because you get more and more credit. That means you decrease two things, both your cost basis and your max drawdown potential. In this case, now our risk is $17,089 and we can collect 1.73% in 25 days. So once again, we come back at call expiration. As we have already seen, the total return that we got in credit from the options until now is $365 from the put plus $296 from the call that we just sold. And there's essentially two options. Option number one is the stock stayed flat or it rallied a little bit, but is still below 182.5. In that case, you just repeat this process over and over again. You sell new call, you get more credit. And again, the more calls you sell, the more you decrease your cost basis from the credit you are getting. And the beauty of it here is that the stock now maybe is trading at 170 or 175. And if you compare it with buy and hold, you would have a very significant loss. You bought at 187 and the stock now is trading, let's say, at 170. You have a loss of $1,700. But With the wheel, with implementing this strategy, even though the stock now is trading still at 170, you got $661 in premium and you were assigned at 177.5. So you have a loss of less than $100, even though the stock went down more than 10%. And option number 2 is at the expiration. Now your stock rallied back up and is trading at above your covered call price. So let's assume the stock now is trading above 182.5. So what happens is your shares get called away. It doesn't matter how much above 182.5 it's trading, your shares get called away at 182.5. You sold a call, so you have the obligation to sell those shares at the strike price. When that happens, you just sell a new put and you restart the wheel. So let's look in this case what our return would be like. So our options return we already saw is $661. Our stock return would be 100 times because you have 100 shares in one options contract, and times the difference between your assignment strike that was 177.5 and your covered call strike 182.5. So in total you have $5 of difference in between your strikes, 100 shares, that gives you $500 in the share side of the equation. So total return, you made $1,161 in 50 days. That's a pretty meaningful return, mainly when we look that the stock did nothing during this time. We are assuming the stock came down and rallied back up, but essentially the stock might still be at 185, might still be at 187. If you had just bought and hold the stock, you'd have a small loss or you'd have no profit. And the point is, with the wheel, you can get a profit even if the stock does not rally up. You are getting here a profit of 5% in 50 days just from the stock essentially going sideways. Okay, so let's recap and summarize all the possible options here to make it simple. You start by selling a short put and you get that credit upfront. 25 days later, you come back and either the price is above your short strike, and in that case you pocket the premium and you sell a new put, or the price is below your short strike, you get assigned, you buy the shares, and you have a profit that is the credit that you receive, and you have a paper loss that is on the open shares. Again, this is just a paper loss. Eventually, when the shares rally back up and go above your strike, you will clear that loss and you'll turn it into a profit. What do you do in that case? Well, you sell calls above your cost basis. And let's say that you are assigned on the put and you sold a call. You come back at the call expiration, and once again, there's two options. Price is below your call strike, so your call has not been assigned. You still have the shares, you get more credit, and you keep doing this process and selling calls above the cost basis. And option number 2, it rallied back above your short call strike. In that case, you restart the wheel. You were assigned on the shares, and what happens here is that you have both an option return, so you are getting your $661 in credit from the call plus the put you sold, and you have a stock return. In this case, in this example, it is $500. Putting it all together, you can see how you can aim at returns that are very significant in stocks that are not moving a lot. You are getting 6.5% in this example in just 50 days. Lastly, I want to talk about stock selection and risks. The risks mostly are the same as buy and hold, and you have to keep in mind the wheel is not a let's get rich quick type of strategy. It is a strategy to complement buy and hold, and that can improve your returns mostly in markets that are not strongly uptrending. You can get much better returns compared with buy and hold. So stock selection is critical. You want stocks that you are comfortable to buy and hold them, because if the stock goes down, you have a risk that your capital is tied up for a long time, and there's a risk that the stock does not rally back up for 1 month or 3 months or even up to a year. So please select stocks that are liquid, and usually I like to select stocks that are on an uptrend or sideways market, but at least that on a 1 year time frame they are going up. Do not try to catch the falling knives. They can keep dropping hard, and then your capital is tied up and you cannot do anything with it. I like to trade the Qs, SPY, certain sector ETFs. I like to trade NVDA, is one of my favorite stocks to wheel on, and I like to trade Apple and Microsoft and all these type of stocks that I'm just happy to own. And why does it work? Well, one, you're getting paid to do what you're already doing anyway, buy high quality stocks at a discount. Two, you make money even on sideways markets. This is where buy and hold leaves money on the table, and you can maximize your returns by implementing this strategy. And three, you limit your downside. Even if the stock drops, you're collecting premium, you are reducing your max drawdown, you are reducing your cost basis. Once the stock rallies back up, you'll be in profit much sooner compared with buy and hold. Over time, you do this again and again with a diverse portfolio of stocks, so that you don't have a lot of concentrated risk, and you can be looking easily at 20 to 30% annualized returns. If you found this useful, let me know in the comments, and I'll go deeper into stock selection, risk management, and real trade tracking. Let me know if there's any ticker you'd like me to look at, and I'm documenting my entire journey trading a $50,000 account with full transparency. If you want to check how I integrate the wheel into my portfolio, check out my video updates.